Good morning. Welcome to this TreasuryONE Finance Ghost webinar. Mr. Finance Ghost, I'm going to hand over to you to do the introductions and start it off for us.
Yeah, thanks, Wichard. Thanks everyone for attending. I know it's already December, as I've been joking in Ghost now. It's a feeling more than a month, and I think it's all around us, definitely. So thank you for making time to join us this morning. I think it's going to be a valuable session. I think as per usual on these TreasuryONE webinars, Wichard's going to kind of hit us with the TreasuryONE thinking around a little bit of what happened this year, a little bit of what might happen next year. Obviously, as you know from reading Ghostmail, TreasuryONE are experts in matters of macroeconomics, currencies, interest rates, and how these things actually play out in the markets. And I think we'll then have a nice Q&A session like we usually do. So feel free to start typing your questions. We'll address them at the end, but you're very welcome to type them in the meantime. And otherwise, enjoy it. And Wichard, I'm certainly looking forward to learning from you as well this morning. So over to you.
Yeah, good morning. Again, thanks for that. So I'm gonna start. There's like three things that pop out at the moment. The one is obviously geopolitical wars that's still ongoing, although it's calmed down a little bit now, and there's a ceasefire in the whole Middle East, Israel-Hamas thing. It's still pretty big, and it can still probably spill over. We haven't seen it spill over in financial markets because it's been so isolated. But if you just look in these oaks, do an index, you'll see that when Hamas invaded Israel, it was a bigger thing on their scale where they monitor than when Russia invaded Ukraine. Again, obviously the Russia-Ukraine war has got more financial impact because there was oil and grain and all those spillover effects it had. And while the Israel and the Hamas thing is very, very isolated. So we saw like oil prices in the period. You'll see previously when there was stuff that happened in the Middle East, oil prices all spiked. We saw oil prices spike briefly, but oil prices actually now trading a lot lower than it traded when they invaded. So it's been very contained, very isolated from that perspective. So, but again, geopolitical impacts always has the potential to spill over and cause bigger eruptions. So that's why we always just need to watch out what happens from a geopolitical standpoint of view. Obviously, Russia-Ukraine hasn't been sorted. It's still lingering. It's not headline driven anymore. But that war is actually still going on. Although there's a ceasefire at the moment in the Middle East region, it still has the potential to spill over. We've seen with the OPEC Plus meeting over the weekend again, there's no clear direction from them about how they're going to do supply cuts. Some say they must do, some must not. So there's no cohesion at the moment. So it's still brewing, it's still simmering down under, although it's very contained at the moment. It's still something that we need to watch. Even if you look at gold, it's been on a roller coaster in the last yesterday was a particular big roller coaster. But normally when stuff and the world goes into turmoil, we'll see gold rally, and we can see gold up above 2,000. Yesterday was at $2,135. It came all the way back another $120, gave up 6% of the gains. But gold oil price ratio, it's sort of been stable at the moment. But with gold prices popping up at the moment, it's definitely something, they're definitely saying something is brewing in the world from that perspective. And that's because if you go over now to where the trouble probably is brewing is, everybody's been talking about US exceptionalism and the US economy is growing, and we've seen GDP, the second estimate GDP, Q3 GDP came out last week at 5%, which was better than the expected number. So somehow the US economy is still pumping ahead and roaring ahead, but the rest of the world is sort of, Germany is struggling, France is struggling, Eurozone is struggling, China is struggling, South Africa is struggling. Everywhere is struggling, but the US is still going well. But like I said, gold's rallying, so it tells us something is probably brewing. And if you look at banking conditions in the US, you can see that's deteriorating. It's back to sort of levels where we saw in the 2008-2009 crisis, We've already had a mini banking crisis in the US in March this year, but at the moment banks are very are tighter. They are not lending as much, and the conditions from that perspective is definitely declining. Together with that, dollar liquidity in the market is definitely being drained, and that's why the Fed interest rates has continued to go up. But the Fed pumped up a lot of money into the system, but they're draining that money out of the system by about the tune of $90 to $95 billion at a month at the moment, where they're buying back their own bonds to try and drain liquidity out of the market. And our partners at ETM, they do this dollar liquidity cycle for us on a monthly basis. And you look at the top side, you'll see all the top headlines is when the markets are booming, and all the bottom parts is when there's crisis normally. So you'll see that this line has come rapidly down. It's sort of stalled at the moment, but the Fed is still draining liquidity. So the liquidity cycle is definitely something that needs to be watched. I've just spoken about bond yields, but here you can see our bond yields in the US have rapidly increased. It's back at 15, 16-year highs. We haven't seen this level in bond yields in 16 years. So it's almost a whole generation that hasn't seen these interest rates in the US. Even in South Africa, where we're currently, it's been more than a decade since we've last seen these interest rates. So for a lot of people, it's the first time they're experiencing interest rates from this magnitude. But the thing is, at the moment, we can see central banks are at the top of their hiking cycle. A lot of the Fed, the Bank of England, the ECB, they've all rapidly hiked interest rates from sort of the back end of 2021 and 2022 up until mid-2023. They've been hiking interest rates rapidly. But at the moment, the market is pricing that's the top of the hiking cycle, and some cuts is available. We've seen that market is pricing that the Fed can probably cut 4 or 5 times already this year. There's been a lot of Fed speakers like Jerome Powell on Friday and Waller. They all say higher for longer. The market's not quite believing him at the moment. So this model at the moment is only pricing like 3 cuts, but people expect like 4 or 5 cuts is probably. So the top of the interest rate cycle is probably with us in the US as well. South Africa's interest rates probably also at the top of the cycle. We'll just need to watch what happens with inflation. So again, if you look at the Fed's balance sheet, and I just spoke about the draining of liquidity, you'll see here in the beginning is in 2008 up until 2020, over that span of 12 years, the Federal Reserve printed money and pumped their balance sheet from about $1 trillion up to about $4 trillion. Then all of a sudden, COVID happened and everybody was uncertain. They weren't sure what's going to happen. And all of a sudden, in the space of like 18 months, the Fed pumped in an additional $5 trillion worth of liquidity. So all that excess liquidity is still sitting in the US. And you've just started seeing now that they started draining liquidity. This on the right-hand side here, this little blip over here is when they pumped back in liquidity when the banking crisis hit in the US. So the banking crisis hit, they pumped in liquidity, wrote off all the shareholders, shifted all that assets back to bigger banks, and the banking crisis was solved, and they started draining liquidity again. But they've drained liquidity to around $7.8 trillion. So they've only drained about $1.2 trillion out of their balance sheet. So there's still a long way to go for their balance sheet to get back to like the $4 trillion where it was in 2020. So that's part of the dollar liquidity cycle I mentioned earlier, that the Fed is still draining liquidity out of the market. The other problem that the US is having at the moment is in South Africa, we had a medium-term budget speech not long ago, beginning of November, call it 5 weeks ago. And everybody, I'm going to get into South Africa a little bit later, but just everybody in South Africa was worried that we're going to have not debt to GDP, our budget deficit's going to be around 5%. It came out at 4.9%, which is slightly better. But in the US, they're running budget deficits north of 5%, 5, 6%. And even their budget offices expect that budget deficit to go up to like 7.5% in a decade from now. So by having a massive budget deficit, they need to print money and continue to print money to fund themselves. One of the reasons why the budget is budget deficit so big is actually the US is fighting like two proxy wars at the moment. They like funding Ukraine against Russia, and they're also funding Israel against Hamas. So they're fighting two wars on their own at the moment. The government continues to spend, and that's why this US exceptional is out there. The government spends. It's not a lot of other spending. It's the government that spends. It only helps for a little while, and then the tide needs to turn. So it's been growth supportive at the moment, but the tide is going to turn somewhere. You got to fund your deficits somehow down the line. Another thing where the US continues to grow is all that excess money that they printed. They wrote checks to normal people on the street like you and us. They gave them $1,200, $1,300 extra every month for a period of 15, 16 months. So imagine everybody of us just getting $25,000 a month tax-free into your account on top of your salary that you earn. So all that excess saving went into personal savings, and that personal savings went up to like 2.25 trillion. But with the housing cost that's happening at the housing prices that's went through the roof, interest rates that went through the roof, the cost of living crisis with food, all the inflation episodes that happened, is the US consumer is draining on that personal savings. So they've drained about $1 trillion of those savings, and it continues to decline. So that's hence one of the reasons why the US continues to grow. So everybody had this little buffer inside of them that they held, but they're using it at the moment. So they're spending it. And one of the problems that we have at the moment, why we're saying it can run into a problem, is when yield curves invert. When your shorter dated rates, your 2-year rates, where you can borrow money from the government in 2 years, is at higher rates than your longer dated rates, 10 years. It means that there's a problem. It means that in the short term, the market thinks there's a problem. So you'll see every time there's little gray blocks, every time that the yield curves inverted and it started to uninvert again, the crisis and the recessions in the US hit. So we think there's problems still brewing in the US from that perspective. And then why I spoke about the money printing from the US, tying up the balance sheet, you'll see empty money supply. It's the much money that print into the economy. You'll see the blue line here, US money supply. They grew money supply by about 24-25% year on year in 2021. And you can see the black line, how it just dragged inflation up with it. Now they're draining liquidity. They stop printing money. They're draining that money out of the economy. And you can see how the inflation on the black line has followed. So it's something we need to continue to watch. And we think as long as the US continues to stop printing money and drain the liquidity, consumer inflation will come down with it. There will be a few hiccups along the way. Obviously, food inflation, logistic costs, all those costs. As soon as you've risen it, prices just doesn't come down all of a sudden. So means inflation can maybe stay higher for a little bit longer, but definitely with money supply coming down, does drag inflation down with it as well. Then part of the cost of living crisis that we have in the US is, if you just illustrate, is the housing market in the US. So you'll see here this blue line again. That's the average 30-year mortgage rate in the US. That's just shy of 8% at this stage. This black is the demand for bonds and mortgages in the US, and you'll see it's inversely correlated. As soon as interest rates went up, you'll see the demand for mortgages just summited down, and it's now at levels we haven't seen since the great financial crisis. The other reason why the demand for mortgages is down is the housing market in the US works a little bit differently. Is where in South Africa, 95-98% of housing and mortgages and bonds is at floating interest rates. So as soon as the Reserve Bank hikes interest rates, our mortgages resets and a higher interest rate kicks in. The US works differently. They've got a lot of fixed interest rates. Some people fix 10, 12, 5, 10, 15 years ahead. If you go here on the right-hand side, you'll see the blue line again is the same blue line here. You'll see the average 30-year mortgage rate now in the US is 80, but the effective rate where people are still having their homes is sort of less than 4%, like 3.75%. Just means people don't want to sell their houses and buy a new house. They want to hold on to their home so they don't have to reset the interest rates at a higher interest rates. Because the problem is, and you'll see here, you'll see the number of houses sold. You've seen that's fallen off a cliff. It's actually negative at the moment. And the reason because of that is the principal and interest shown on the right-hand side. Before the whole interest rate hikes and the printing of money was about an average of $1,000 per month. Now that's sitting almost at $2,250 per month. So that's doubled. So the housing market's stalled. Inflation is still a problem. High interest rates in the US are still there. So there's a lot of problems in the US. Then again, if you look at the labor market, they've shown that the unemployment is still sitting at 4%, but we can see that job openings is declining. Turnover in the labor market is lower. It means people are not searching for jobs, they're holding on to their jobs, and there's less and less job openings. So the robustness of the US is definitely starting to show its cracks at this stage. Again, if you look at this chart, permanent job losses in the US, it's sort of turned the corner, it's up. So what a lot of companies are doing is they're changing their staff from permanent to temporary jobs. So if you were permanently employed at a factory manufacturing something, they've switched your job now. So you still have a job. You're not working 5 days a week for us. You can work 4 days a week for us on a flexible hours. So they're switching it from permanent to temporary. So although the unemployment is still sitting like at 4%, the quality of jobs is definitely switching at this stage in the US as well. And again, here you can see the blue line is how interest rates go up. And as soon as you start interest rates go up, every time interest rates goes up, you'll see unemployment sort of starts to go up. We haven't turned the corner, but you can see it's just slightly starting to tick up at this stage. So it's definitely something you need to watch is the unemployment figures out of the US. On Friday this week, we have US non-farm payrolls again, which will give us a good indication of what's happening in the job market in the US. Again, just the trouble that the consumer is in is credit card delinquencies in the US is definitely rising. It's sitting at levels we haven't seen in 30 years. And the smaller banks, it's like 7.5%, 8% of people are defaulting on the credit cards. And even if you include all the big banks, if you include the JP Morgans and the Goldman Sachs and the Citibanks of these worlds, even their delinquency rates are up at decade highs. So it's definitely the consumer in the US is definitely feeling the pinch of higher interest rates at this stage. Then I'm going to go over now to South Africa. There's problems in South Africa brewing as well. Everybody knows about it. I'm just going to highlight a few things. I've spoken about the budget deficit, and again, here, if you look at the medium-term budget speech, this green line over here, it's sort of at 4.9%, and then the government expects it to go to like 3.6% of GDP in 2026. Better than expected, but still worse. The problem is, if you look here from our 2023 budget to our 23 medium-term budget, you'll see that the debt to GDP, our gross debt to GDP, has risen by about extra 4% of GDP. They're expecting it now to peak at like almost 78% of GDP. The scary thing is there's a lot of debt that doesn't sit on the government's balance sheet. So all the municipal debt doesn't sit on the government's balance sheet. Actually, if you include all those debt, then our gross debt to GDP outlook is almost closer to like 100% of GDP. So it's a very worrying thing that we need to continue to watch in South Africa. If you look here on the left-hand side, you'll see 15% of our budget on a yearly basis just goes to servicing debt at this stage. Not principal, just the interest portion of of debt at this stage. Again, if you look, these figures here on the right-hand side come straight out of National Treasury, and you'll see debt service cost is 1.2, almost 1.3 trillion rand a year. It's the second biggest line item of spending in government at this stage. Only learning and culture is higher than social development, health, community development, economic development. So if this country was just run a little bit better, and we didn't have as much debt, can you imagine how much, if half of the money, we can just reduce this 1.3 trillion by half, how much better we can spend another 600 billion in this economy. But yeah, the government, they're not fixated about that. You're going to go to the ETM aparters again. They do like a policy scorecard of where we are. Anything above 50 is good. Anything below 50 is not good. So again, if you look here, from when Jacob Zuma took over into the Cyril Ramaphosa, our political scorecard is just continues to decline. And that's just, we haven't got, and you can see it from worldwide. That's why we're grey listed. That's why we're in junk status. That's why we've got all these problems. Is the world just hasn't got confidence in our political leaders at this stage to make the willing decisions to get the country out of the problem. It just continues to decline. Sort of when Thabo Mbeki was our president, it was sort of a golden era. You can see the political scorecard was on the up, but now since Jacob's taken over in 2009 and subsequently Ramaphosa, it just fallen off a cliff. Then again, we spoke about government and spending, and if you look at this chart, the black line is businesses, employment by business, by private sector, and employment by government. So again, if a company is not doing well, they do a lot of things to do cost cutting, restructure it, get it nimble, to get it growing. And that's exactly what private sector has been doing. But government has just continued to use the public sector as trying to employ people in the public sector to keep people in jobs. But it's the wrong thing to do, actually. The private sector is actually the resilient thing in this country, and not the public. So we've got a massive public wage bill, and it's actually adding no value to the economy. There's a multiplier effect. It means that every rand that the government spends, you need to get 1 rand 5 cents or 110 cents back out of it. At this stage, for every rand the government spends, I think South Africa is lucky to get 70 cents back. So they're spending, but they're not getting the return. The multiplier is on the wrong side of things. Again, if you look at borrowing, again, this golden periods with Thabo Mbeki, you said they declined. Actually, they lost a lot of private sector. They relied a lot on private sector, and they got government borrowing down. And then all of a sudden, you can see when Jacob Zuma took over the presidency, government borrowing went through the roof. This is a little caveat here. This first part of the borrowing was when the global financial crisis hit. So it was sort of to help the economy, but the rest of the excess borrowing has got nothing to do with financial crisis. Again, when Cyril Ramaphosa took over, this little spike here is again when they announced that 500 billion spent for COVID. It's reduced, but still they're borrowing at a lot higher rate than it were previous regimes were borrowing. And again, if you look at South Africa's government revenues versus expenditure, the blue line is revenue and the black line is expenditure. Again, if you look at this period, revenue was all right. And then when Thabo Mbeki was in control of president of the country, they reined in government expenditure, and it was sort of in line. And again, now you'll see that expenditure is just running a lot higher than where revenue is going. The fact that the current economy is still growing, albeit at a slower pace, it's a miracle in itself. And it just shows you how resilient the private sector is. Again, we're going to speak about the Bureau of Economic Research. They do a political climate chart again. Again, above this chart is inversely correlated. Above 50, it's worse for the country. Below 50, it's good. Again, in the Thabo Mbeki area, there was no risk on political climate. At the moment, political risk in South Africa is sky high. And it's all this maladministration, the corruption that we read about on a daily basis, just no accountability. Nobody gets torn to task. If you take the state capture report, it's been out for how long? But nothing's been done. So then you read in the newspaper or on Twitter that our president says South Africa will stop bad-mouthing the government and start telling the good stories as well. The problem is just the good stories is so far between at this stage. It's difficult to tell them. Even if they just start of arresting someone for state capture and throwing someone in jail for state capture, I think it will be a good start. But just be it as it may. Again, then we go over to interest rates, and we've obviously seen the rand under pressure for a while. And that's part and parcel because if you look at where South African interest rates are, we have this thick black line versus our Latin American and other emerging market peers. Our interest rates is actually far lower than where their interest rates are. So I know everybody's feeling the pinch and it's hard out there with higher interest rates, but in fact, a lot of the other emerging markets in our space hiked rates earlier than we hiked rates, and they hiked it much faster. And that's why their currencies have been a lot more resilient than the South African rand. And again, if you look at our partners at ETM has done this for us, is bond outflows and the rand's correlated. Means a lot of foreigners were looking for more attractive yields. They didn't find in South Africa. They sold their government bonds, sold their equities, and they flighted to other emerging markets. And that's one of the reasons why the rand's been under pressure. It's very nicely correlated at this stage. Again, if you look at South Africa against other emerging markets for the year, this is again with the black line. You'll see only the two basket cases, Russia and Turkey, has performed worse than South Africa. China and all the Latin American countries actually have done a lot better. Though we've ticked up recently when the rand sort of dipped back to like 1860, we're still way behind where our emerging market peers is, and just a function of interest rates in South Africa. It's a little bit too low at this moment to really attract foreign capital, and then we've highlighted all the political issues. And all the political issues. We can go into the Transnet issues, the Eskom issues. We're going to get into that. But there's all those issues at the moment that also has a drag on the local currency from that perspective. The other thing is the dollar. The dollar on its own has been overvalued, and that's because of this US exceptionalism. They have higher interest rates, their market's performing, so they attracted a lot of capital. But it's so overvalued at this moment, and we've mentioned about budget deficits, they're running trade deficits, they need to fund themselves, so they need to start printing money again. So that won't bode well for the dollar in the medium to long run. It needs to correct to better levels. And besides that, South Africa does anything well, the rand could stand to benefit from the dollar overvaluation. Just comes back from its very overvalued perspective. The rand's biggest problem is Eskom. We can feel it. We stage 4, then we stage 5, then we stage 6. We have had more load shedding 2023 than the previous 10 years combined. So it's hampering businesses. So this blue line is Eskom's electricity availability for distribution in South Africa. So now they're producing electricity at this stage at levels back 20 years ago in 2000. The black line is the total electricity production of South Africa. So that correlates with this line here at the bottom, this golden line. That includes, it's just IPPs and all the extra generation power that's been created by the private sector. Follows this gap for about another 3 gigawatts. So our partners at ETM has done a lot of work, and they reckon that if you include all the households and all the other private businesses that spend money on electricity generation for their own use, we can boost this production, South African total production, by another 3 gigawatts up to 20 gigawatts. So South Africa in itself is producing electricity at the same level where it was 2010, but 25% of it's coming from the private sector and only 75% is coming from Eskom. The problem that Eskom has at the moment is they're booting their best customers, guys that's actually paying for the electricity. Their biggest, best payers are rapidly moving away from them. So they desperately need to restructure, and we've seen the World Bank agree to the breakup of the transmission and generation businesses. So desperately needs to do something in Eskom. Again, if you look on the right-hand side, that's electricity intensity of South Africa. That's how much it's fallen off a cliff. So the electricity intensity of South Africa, it's levels we haven't seen ever. So the fact that the private sector is actually still growing this economy, it's flabbergasted actually how resilient the private sector is in South Africa. Again, these two things are out of National Treasury. They've reckoned that the problems that we have at Transnet cost South Africa about 5.5% of GDP last year. They've had a lifeline now of 47 billion rand thrown to them so they can go borrow more money. They've got the Philippines company that they want to run the Durban Harbour. They just haven't implemented it. So there's a lot of good ideas at the moment, but the implementation of it has been so poor. So we need to watch the space and see what happens. But again, I've spoken about load shedding. You can see in 2023, if you go 18, 19, 21, 20, 21, 22, all those combined is less load shedding than we had in 2023. So the fact that we're going to eke out growth in 2023, it's a miracle actually at this stage. Again, the blue line is world growth and the black line is South African growth. And you'll see South Africa and world growth has always been similar. And sort of here from 2012, 11, 12, it's sort of broken away. That's when load shedding started kicking in previously, when state capture started in quickly, when we started losing our statuses of credit ratings. And although that the economy is still growing, albeit very slow, there's a massive gap between us and world growth. So if we could have just grown in sync with where world growth was going, not even outperforming or just close to where world growth was, our economy could have been 1 to 1.5 trillion rand bigger at this stage than where it is currently. And that's just the fact of how maladministrated this country is at the moment and how rife corruption has been running. So luckily for us, we're still exporters. We're still resilient in that space, although commodity prices has come down, but oil prices, which is our biggest importers, also come down. And although everybody can't wait for petrol prices to come down tomorrow night, it looks like there will be good news and in January front when we start 2024, as there is likely to be an over-recovery on the diesel and petrol price in the month of December as well. So again, if you look at Argentina, Turkey, South Africa is sort of mid-pack, and that's because of terms of trade, where we export a little bit more than we import, is still holding up well and supporting the currency. Again, if you look here, there's a little bit of a trade surplus. Although here in 2021, when the Russia-Ukraine war happens and palladium and all those metals and rhodium went through the roof, the trade surplus was a lot bigger. We're still running a trade surplus at this stage, which is still supportive of the currency. Again, we've spoken about it. The rand's undervalued against the dollar, but on a trade-weighted basis, if you look at our basket of currencies, we're sort of more fairly valued, and that's because a currency like the yen is so undervalued at this stage. The yen has lost like 25% of its value at this stage of the year. It's because of they not having interest rates. So on the basket of currencies, the rand's actually not doing too bad, but against the dollar, we're very undervalued. And from that perspective, I'm gonna stop. I'm gonna hand over to Finance Ghost and see what we take from here.
Yeah, Wichard, thanks. I think I speak for everyone when I say that was incredibly interesting. I was like making lots of notes while you were talking. I really, really enjoyed that. So I think to all our attendees, please start sending through your questions. I do have a few of my own and maybe a few comments. And the one I wanted to actually bring up was those high mortgage rates. So it is fascinating to understand how different it is in the US in terms of how the mortgages actually work, right? And I guess when it's so difficult to buy a house, what you end up with is a scenario where there are more renters and fewer landlords. And actually what ends up happening then, I assume, is the landlords put the rent up, right? Because there's more and more people who want to rent. So there's kind of this weird situation where having these very high rates to fight inflation is probably driving rental inflation. I don't have any data offhand to support that, but I mean, just logically, that kind of makes sense, right? So that's like an example of a point where rates can actually do more harm than good in terms of trying to fight something like inflation. You know, love your thoughts on that.
Yeah, so if you look at rental inflation in the US, it is still keeping inflation up. But what happens now is the homeowners are trying to put rental up at the same pace that they want, but then people are just moving, they're just downscaling. So they are moving from, let's say they stay in New York City, they're just moving out of New York City to a cheaper place. And work from home has also helped that scenario. So people are in the rental market, it's easier to downscale. So the guys struggle to put up rentals as much as the affordability comes. And then people sort of just try to keep people in their homes to get some income and fund the deficit than rather than have the place standing empty. So it does keep inflation up, but to a lesser extent than you would expect.
Okay, well, as a happy renter, that's music to my ears. I'm glad to see that, because I can definitely see in Cape Town, rentals are definitely going up. So these inflationary pressures are kind of everywhere you look.
No, definitely. Nobody's immune to it, unfortunately.
Yeah, exactly. There was that great chart you had as well of that golden period. So it reminded me that I basically studied the whole way through that golden period, and I entered the job market literally in danger zone and just basically have never left. I've only ever known pain. I'm always quite jealous of the people who worked in banking in that beautiful bull market pre-crisis. But moving on from a golden period to gold, and I think that's something that obviously is very topical at the moment. You know, the TreasuryONE updates every morning in Ghost Mail. I always include, the gold price, and obviously it's rallied really hard, then it corrected big time in the last couple of days. So I guess gold, I will always scratch my head about it, because the sort of conventional wisdom is it's a bit of an inflation hedge. It kind of looks more like a safety net, but I still think no one really knows, to be honest, what actually really drives the gold price at a point in time. So much of it is sentiment. What is your view? If someone said to you, why would I own gold for the next 10 years? What are you really buying? Are you buying an inflation hedge? Are you buying a geopolitical safety net? What do you think?
I think you buy a little bit of a combination. There's only so much gold that you can mine in the world, and that's sort of where money, before the Bretton Woods system went, all the money was linked to gold, and then they sort of delinked it in the 70s, and then we had the inflation period. So gold is sort of, it's always a safety mechanism, because you can't print it. You can only, so the dollar or the rand or any currency, you can print it, and you just run a hyperinflation if you print. If you look to Zimbabwe, they just continue to print Zimbabwean dollars, and they have hyperinflation at the moment. So gold's one of those things you can't print it. You can travel with it, you can save it. So and you can barter with it. So it's a little bit of a safety net. It's an inflation hedge. It's a bit of both worlds. So in times of uncertainty, gold certainly tends to boom, and we've seen it. Now there's more and more uncertainty coming around, and then gold sort of, when interest rates are low and the world is booming, gold tends to underperform. So it's one of those things that will always be an interesting asset class, because it's a non-bearing interest asset. As you buy gold and just keep it, you're not in the interest or in a bank or whatever. But it's good if you have gold and all of a sudden a war breaks out in South Africa, and they close banks, you still got gold. You can still go somewhere and sell your gold. you can't have money. So it's a bit of both from that perspective. I hope it answers your question.
Yeah, it does. I guess for me, the lesson learned with gold is, if you're buying it because of inflation and you buy the miners, then the problem is their mining costs obviously go up with inflation just as much as the gold price does. And you actually end up not necessarily having a great time, versus when it does like these big moves, you make a lot of money in the mines. So it's interesting, the commodity versus the mines.
Yeah, the thing is for mining companies, I think a lot of their costs actually is kind of inflation plus. A lot of things is cost plus. So their revenue, so gold's had a good rally now, but if you look at the share prices, the market doesn't believe that the rally is sustainable. So the share prices are lagging what the gold price is doing. It's because costs will still continue to rise, and I'm not sure that the revenue continues to rise at the same pace. So that's why there's a bit of a lag at the moment from that perspective.
Now, the other one I wanted to ask you, and Neville, Andre, we will get to your questions, I promise. The other thing I wanted to ask you, had that chart in there about electricity intensity, which is obviously a super depressing, but very, reality check kind of chart. That presumably, and sorry if you mentioned this and I missed it, but presumably that only measures Eskom, right? So that's not measuring the fact that a whole lot of electricity generation is now happening on people's roofs or shopping center roofs, that kind of stuff. This has got to be from Eskom.
No, so the electricity intensity is just the electricity that South Africa generates divided by the GDP. So it takes all of the electricity intensity into account that they can measure. So it doesn't include like the households and people that doesn't procure electricity from IPPs. But again, even if you take the economy has grown in the last 10 years, okay. But if we take our measurements and we take all that into account, we're still only generating electricity at the same rate where we sort of generated electricity 13 years ago. So, but the economy is a lot bigger. Economy has grown. So electricity that we generate divided by the size of our GDP, it's still declining at this stage. So it is a worrying thing.
No silver linings on that chart. No matter how hard I try to find one. Well, we may as well go on to Andre's question actually, which is devoid of silver linings, but is a great question, which is, based on how bad our fiscal discipline is, and you also had a great chart there about spending versus income. Do you think hyperinflation is a risk for South Africa? Can we get as bad as some of the genuine failed emerging markets?
I don't think so, because I think from the monetary side of things is we've got a very good Reserve Bank at this stage. Our governor and National Treasury actually is doing a stellar job at this stage. So they continue to watch those type of things, and they'll just hike interest rates to counter it. So I don't think in the short term or in the foreseeable future, I expect hyperinflation. But we all know that we don't know what's going to happen with the election next year, what's going to happen 5-10 years down the line. So for now, for the foreseeable future, I'll say no. But there's a lot of things that can change down the line that can make it possibly a reality. Obviously, if you go to guys like Argentina or Turkey and where it's happened, in Zimbabwe, they also would have told you probably it's not possible, but it happened. So I won't rule it out, but I think it's a very, very low factor at this stage that it will happen. It's like a 1% chance at this, 1.5% to 2% chance at this stage. I'm not going to say zero because it can happen, but I think it's a very low probability at this stage.
And there's a question here from Neville. He's asking you to get the crystal ball out, but you knew that was going to happen, Wichard. Everyone always wants the forward-looking view. So his question is, if you could choose the dollar, the euro, or the pound versus the ZAR in 2024, which of those three hard currencies do you think will do best against the rand?
It's a difficult question to answer. Both has got. It depends if you just want to keep the hard currency. Do you want to invest shares in those countries? What you want to do with it? So
I think let's assume hard currency, because the shares definitely add a whole nother element to it, right?
Yeah. So I feel the dollar is overvalued at this stage. It's going to come back, but the euro and the pound's got its own problems. They're also running still inflation higher than that. In the long run, the dollar stays king. I think there's a lot of talk over about what's going to happen with de-dollarization, and China want to get paid in their own currency. In the long run, the dollar stays king. It's so far removed that they're not going to use the dollar as a reserve currency. The share of dollar payments in the world in the last 2 years has actually gone up and not down. So in the long run, I don't know in 2024, but I just think if you go longer run, 2020, longer run, I will still be happy taking my money into the dollar.
Yeah, that makes sense. I actually want to touch on a little bit of equities as well. So the one thing I also scratch my head at a lot is, valuations of businesses like Apple. So before everyone thinks I'm insane, like Apple is a great business for sure. But if you actually look at the share price performance over the past decade, the reality is that a huge part of that performance has been the valuation multiple expanding dramatically. The underlying earnings at Apple have done okay, but they're not like absolutely amazing. So there's almost this view in the market. Sometimes I think people see Apple as being less risky than the US government because they are happy to own this thing on an earnings yield that is actually in some respects less than long-term US government bonds. I mean, do you think there is kind of this underpinning the market of, governments keep printing money, there's a bit of love lost for, the state of the dollar, the Fed? I mean, it's a hard question as well, but I try to understand how some of these tech companies can just keep trading at these multiples, even when Treasury yields have gone through the roof. Like the money is looking for a home, right? And it's decided that these big tech companies are that home.
The Magnificent Seven. I've got no idea. Like I said, it's the Nvidias and Apples, but somewhere that the tide's going to turn. If you strip out the Magnificent Seven out of the S&P results and the Nasdaq results, it's actually the US equities are actually not doing too well. I'm not an equity expert, so I unfortunately can't delve into it. I just know my own thing. My own mind is it's mind-boggling. Same is how they can keep valuations up and just continue to go from strength to strength. Somewhere the tide needs to turn.
I mean, I'll give you a great example. Is Ford's share price has come under a lot of pressure because of price cuts in electric vehicles and what that does for electric vehicle profitability. But then Tesla, which is only electric vehicles, their share price has like gone to the moon again. So, to your point, that Magnificent Seven, it's just like devoid from any and all reality. It really is. There's a question around RSA bonds and whether or not they are a hold in your view, or what your view is generally on South African government bonds, maybe going forward. Just anything you might be willing to comment on that.
Yeah, so it's not an area of that we give advice in. So unfortunately, RSA retail savings bond is good for the investor. It pays good money. You're taking a view on government. Is government going to fail? But like I said, it's not something we're allowed to give advice in, unfortunately.
Yeah, those questions are always difficult. I think the one thing I'll say is, and I think I said it at our webinar right at the start of this year, because there was a general question about how will equity markets do this year. And I think I said something to the effect of, if you're taking single stock exposure or you're buying broad market indices this year, just remember what you can get, basically risk-free fixed income, because the entire sort of benchmark has moved a whole lot higher in terms of what you can get without really taking much risk. So, if your share has done 7% for you this year, it's actually had a really bad year. I mean, it's certainly done a lot better than some stocks that are down 40%, clearly. But a share returning 6%, 7%, that's still not a great year. So I think as we go into next year, if I look at that interest rate chart that you had, Wichard, which was great, it actually really showed how initially the ECB kind of blinked first, and then the Fed just kind of led the way on all those hikes all the way up. Reality is we are in this sort of higher rate environment. Maybe we've topped out, but I think going into 2024, we're still going to get good yield opportunities, and then equities need to do really well on top of that. You can't be buying a share because you think it's going to give you 9% next year. It doesn't make sense. You're taking risk and you're not getting paid for it. Yeah, you want to comment on that? Got a couple of questions here as well.
No. So I just want to say, I've got 1 or 2 shares that's done that 40% down for the year. So I know how that is. Would have been easier than government bonds, but in any case.
We've all got those. We've all got
those. Yeah. So Reinhard's asked about what the government needs to change to support economic growth. Reinhard, the answer is simple. Get private sector involved. Stop trying to generate and stimulate growth from the government perspective. Government is not good at allocating capital and getting the economy growing, while private sector clearly is. So get the private sector involved and you'll see this economy growing. Get someone from private sector to run. At the moment, all the Transnet tracks, you're only allowed to have Transnet trains, but get private sector involved to they maintain the tracks, but get private sector to run it. The same with Eskom. That's what they're trying to do. So the easy answer is just get private sector involved.
Yeah, I would agree with that. In terms of these safe haven currencies, do you want to comment on Martin's question there? Yeah, safe haven currencies versus gold. Also a tricky one. I don't know if you want to add anything.
It's a very tricky one. It depends. Again, it's so difficult to comment on it because I don't know what people's risk tolerances are and what they're looking to achieve. So it's so difficult to say. You must again, we're giving advice on something that I'm not authorized to give advice in. So again, we like gold. Of my personal capacity, I'm rather holding gold than any other currency. But it's difficult because I don't know what the eventual outcome for Martin wants to be. So it's difficult to give a answer on that.
Yeah, absolutely. I will say one other thing, then we probably need to start wrapping this up, is that great chart on the oil price, and kind of shows how it can behave during different crises. And sometimes it really spikes, other times not. It's very, very hard to predict. But I think as we head into 2024, one of the bear cases for South African retail has definitely got to be an oil price that stays potentially elevated. I mean, it's lovely that it's coming down now, but it's coming down off a disgusting base at the pumps, So it's just something to keep in mind as you look at South African retail stocks, which I'm still bearish on. I was bearish on them coming into this year. It doesn't seem like I was wrong. Pretty much the only one that's really done very well is Truworths, and that's because it came in on a super low valuation multiple. Shoprite's done okay, but to achieve the returns it's delivered, I mean, everything had to go right in that business. Shoprite is in this golden age right now, and even then that share price is giving you 10 or 11%. So I think going into next year, I'm not feeling any better really about South African retailers for all the reasons mentioned, and I would keep an eye on the oil price there as one of the pressure points as well.
Oil price is key because it's the biggest import component in the South African economy is the oil price. So it's definitely something that we import all that inflation as well. So it's definitely something we need to keep our hands on. Just a side note is the JSE is just becoming smaller and smaller and smaller. So it will be difficult as soon as all of the foreigners are leaving the South African market. And I've seen a lot of comments about daily turnover in the JSE that's anemic. So it's difficult to eke out growth if the turnover and the trade is not there as well. So this is a side note.
Yeah, and what that ends up doing is it drives valuation multiples lower. So if you look at some frontier markets with undeveloped stock markets, and we're a long way from that, but to your point, we can't ignore the trajectory here. You'll find stuff trading on 2 and 3 times multiples because there's not enough liquidity. So lack of liquidity pushes multiples lower. And that's also, I think, why US tech, for example, trades at these incredible multiples, is because there's just so much action there. There's so much activity. It helps. That liquidity premium is a real thing. Maybe last question, Wichard, and of course we're ending off on a tough one here because no one ever makes your life simple. So it's a question around some of the policy stuff around NHI, the 2-part retirement system, just your view on I suppose, all of these kind of policies at the moment on short to medium term on the local economy. Is it more stress?
It's more stress. The thing is, the government just can't afford the national health insurance scheme there's just no money for it. So although they want to push it through, there's just no money. There's no money to fund it. So I don't think it's ever going to come to fruition. but it's putting stress. It's for political score points at this stage, in my personal opinion. The two-pot system is good for people that got all these savings and I want to delve into a bit and to stimulate the economy a bit. So I think that can maybe help drive growth a little bit. But again, the amount that you can get out isn't astronomical amounts that you can get out, but it will certainly maybe have a little bit of a boost to the economy. But I just don't think the NHI is going to fly. Although they're trying to accelerate it, I think there will be a lot of it won't succeed, in my personal opinion. But like I said, I'm just setting you on the side. What do I actually know? So yeah.
Yeah, I tend to agree with that view. I think, Wichard, we should probably wrap it up there. We're almost an hour in. That was really, really cool. Thank you so much for your time and for all of the insights this year in GhostMail. It's been really amazing having you guys. And I think to those who want to watch this again or want to share it with your friends, it'll go out on YouTube, it'll go out in GhostMail. Share it far and wide. I think it was filled with excellent insights. And as I said, Wichard, thank you so much for your time.
Yeah, thank you, everybody. Enjoy the day. Cheers.
Ciao.